Good morning, everyone. My name is Josip Kosik. Welcome to the Options with Option session. Today is April 5th, 2022. And if you can take a moment and read the disclaimer. Um, if you take the time to read it, we are disclaiming it that we are not financial brokers. All the examples that we do are for educational and instructional purposes only. And let me show you a place where you can get in touch with me if you choose to. So our email is right here, and also support is right here in case you want to get in touch with me. Another way is to go to the tradewithufos.com/Josip. This is where I keep the notes. Also, if you need a coaching, you can meet with me here. Here's an example of the one of the trades that I did recently, and I'm planning to do the same thing at the end of this session. I'm going to post these live notes. So basically, I'm saying what I did in last session, reviewing these option concept of assignment and exercise that a lot of people are struggling with, and then I went over this broken wing butterfly that is still open because the expiration on that particular thing is all the way in April. So we can revisit that a little bit later, and we are right now ready to jump in a session. And I just want to give you a quick recap of what is going to happen. So basically, we're going to be trading using the top platform. But before that, I want to give you a big picture for just about 10 minutes. So thank you for confirming, Christian, and all like that sound is good. I really appreciate it. And I'm going to start with looking at monthly chart. So when I look at the monthly chart, I want to make sure that we we examine one by one in terms of what they have done, and then we can actually proceed to choose which one we're going to trade. So as you know, this very last bar, it's not complete due to the fact that we just started the month of April. But what is really interesting as of now, we're kind of encapsulated within the price action of the previous month, which was March. So when you're looking at this high, we are nowhere near on the Dow Jones to challenge it and to take it off, right? However, what is interesting at the same time, that we are actually lifting off the lows quite a bit, and we are creating. So this would be the February 24th low. This will be the March low, and this is where we are. So we're definitely creating the what I like to call the higher lows. However, this downtrend that we had intact had been broken to the upside. So this is a very realistic picture of what's taking place on the Dow Jones on a monthly. Now, again, this bar is not completely yet formed, but we are approaching testing of this high. Let's move on to the next in line. The next in line is going to be the QQQ, which represents the NASDAQ 100. And the NASDAQ 100, what is really standing up on that one is that we had two of these, what I like to call bottoming tails, right? That the price has tried to go lower through this low of the February 24th, and it failed. And then it rallied and even tested the high of this February. Now, of course, it didn't close at the high, but it's right now approaching it. And later on, I'll probably go through even some of the NASDAQ components, such as Apple and Microsoft, and you'll see how Apple and Microsoft looks in relationship to everything else. So moving on quickly to the SPY or S&P 500 index. So it's still green for a month of April. However, as I'm pointed out to you, this is not complete due to the fact that we are only several sessions in it. But the fact is that, again, we are having if you really look at closely, we are having these bottoming tails three times: January, February, March, and now we're challenging the high. Now, when you look at the economy and everything, you're wondering how is that even possible? Now, keep in mind, stock market is not economy, or flip it and say other way around, So just be aware of it. What you're looking is what the market is doing. What the market is doing. Now let's look at the Russell 2000, which is represented by the IWM. And what is interesting that as early as February, and I'm going to make this in a circle and I'm going to minimize it and then you guys see it. We on a Russell have had a green bar. So if I need to now point out that one is unlike another, you would obviously see, and I'm going to redraw this circle on it so it will kind of stand out, that here we have a February for a QQQ, here we have a February for a diamonds, here we have a February for a S&P, and a Russell has already started to go where? Higher. So if I can point out to you that the IWM at this point in time is a leader, right? It already started leading in February, but what is interesting right now in the month of April, it's what color of the bar? Well, obviously it's kind of red. So we should be really, really cautious before we decide to go all booyah bullish on it, because as of now, the Russell is not looking that good. Now, the next thing that I'm going to do is I'm going to switch to options with options. And when I do that, I would look at the daily for each of them. And then we're going to observe a few things that I always like to discuss. And one of the things that I like to discuss is a simple concept of where are those things in relationship to the standard deviation versus current reading. So I'm bringing this thing back in just to kind of explain it, that I want to spend no more than 10 minutes on a big picture, because my goal is really to use the top to trade options. And what I have done to actually save some time, I have looked at the 5 different things. I had looked at the VIX, I have looked at these Dow 30 stocks, QQQ 100 stocks, SPY 500 stock, and IWM 200 stocks. And I'll explain what this D60 means and 4/1 in a few moments. But let's now just look at the SPY, because I understand that looking at the SPY is something that is being tracked by majority of the fund managers. They're always looking at their performance in relationship to the S&P 500. So where I'm looking here, and I'm going to start from the top to the bottom, on this top chart, we have a 9-day exponential moving average. And we are observing on the lower study, or I should call it middle study right here, what this thing is doing when it's statistically being measured over the period of 8 standard deviations. I'm sorry, it's for the 6 days. Statistically speaking, when we are above the 9-day moving average, there's supposed to be a turn lower. However, what has happened over here right now, that we actually currently are already 15 days above 9-day simple moving average. So if you start counting from here to here, we really came very low, close to it, closing below it. But as of now, we are still above it, and we have a tick dot, which means confirm bullishness. So this morning, we kind of gapped down, and then we kind of violently reverse. I can just quickly show you on the FinViz a big picture of what this thing is doing. So it was really interesting morning. We opened with the gap down, we rallied up, we pushed even higher, and within these are the 10-minute bars here, within the 20 minutes we came down to test the low, and now we're back to pretty much flat or a positive on Dow Jones for a day. Now the Nasdaq has gapped down, and ever since then it just kept going lower. So what I'm doing right now, I'm pointing out to you in terms of the relationship of what the SPY is doing, that the SPY has 6 standard deviations of normally turning, and right now it's on the 14th day of being up. So if anybody's gonna go long right now, they should be extremely cautious. While I'm on a SPY, I'm gonna pull up the daily and I'm gonna be observing whether or not we should be directional on it or non-directional. So now I'm moving away from the left side to the right side, and I'm switching here to the daily. And this number right here, when I have taken account um, earlier in a session, it was reading 56. Now it's reading the 45 because of all this fluctuation. So it's suggesting non-directional trade, non-directional trade. So I'm going to just change this number from what it was earlier in a session to 45, because anything less than 45 means a non-directional trade. Anything higher than 45, anything higher than 50 should be directional. So notice, as a SPY goes, so does the uh, rest of the market. So on a QQQ, you're going to observe that for QQQ, we have had a different situation, and QQQ is already down. Let's just observe it. How is this looking on this bigger picture? I'm a little bit over 10 minutes right now talking about it. So we have a 7 uh, standard deviation pointing out that we're supposed to make a turn down, and currently we are now at the 14 days above the 9-day moving average. So there's a high chance that we may actually turn lower. And when I was looking at the daily earlier in the session, it was pointing out that the number was 60, and now the number is 4250. So again, I'm going to change this number to be accurate, 4250, and I'm going to just point out this very simple. This kind of fast approach leads me to the conclusion there's no directional trade on a Q. There's no directional trade on a SPY. However, two of them are different. Obviously, IWM we didn't yet evaluate, and the Dow Jones we didn't yet evaluate. So I'm going to jump first on the IWM because that was the strongest of the 4 ETFs. Because remember, when I was showing the monthly, it was showing the green bar as early as February. So I'm going to now jump right back to IWM. And when this thing loads up, you're going to observe that standard deviation is 4. Depending where this bar is closing today, we might have a first down day on the IWM. Now again, on the daily right now, this showing the 48 because of the huge fluctuation that has taken place. But earlier in the session, when I was reading this at the open, it was reading 60. So there might be the possible trade. On IWM that is directional. 48 is not that far from a 50. So really, I mean, sometimes we need to be flexible with the rules, but make sure that you don't tweak it too much, because every time when you tweak it too much, it might come to punch you. So we're passing on these two that we already addressed. But now, as Albert Einstein said, everything exists relative to something else. Between these three, IWM looks possibly the one trade in which we can trade, but we didn't check yet the diamonds. So let's check the diamonds, because I was pointing out to you, diamond as of this morning is showing the relative strength. While the NASDAQ and S&P are down, NASDAQ is down over 1%, S&P is still below the open or below the yesterday's close. Dow is already showing some strength to go up. Now, again, I can make a counter argument. Well, it's only 30 stocks and all this type of thing. So let's now stick to the facts and not opinion, and use the top platform to tell us where the diamond is in relationship to the 9-day exponential moving average. So this 9-day exponential moving average is pointing out to us that we are currently sitting with a thick dot, which means we're above it, and it's confirmed uptrend. Okay. What is interesting, This is the second day out of the possibly 5 days that we can go up. So this would be a drop. We created the consolidation, and if the market strengthens up, we may actually go higher. And over here on the daily, it's still showing that we're at the 44.59. That's not the best possible reading for a directional trade. So we have a conflicting signals. We have a conflicting signals of what we can do or we cannot do. So what I can do right now, I can actually update this list to make sure that we have the things, realistically speaking, in place. So we have this at the 44. It leads us to believe that the IWM between the diamond and the Russell is a better bet. However, the Dow, it seems to me, it's more like a bullish candidate, and Russell, according to what I have seen, it's more like a bearish. So I can entertain both of them, but I eventually need to choose which one do I want. So Dow would be bullish, but in this environment, when I bring the FinViz and just elaborate a little bit about these sectors that are right here, it really doesn't sit well with me to jump on the Dow because right now 68% of the stock market in US is down trading down. To go long, it would be going counter trend. Now there are pockets of strength such as the healthcare. So we might consider the healthcare in a moment, but I'm saying it would be going against the market if you decide to go bullish on a Dow. And again, another thing that I'm hesitating to go bullish on a Dow because this number in comparison to in terms of the directional trade, it's lower than what is on IWM. IWM this morning was actually at 60. Now, of course, all this fluctuation has caused us to consider that it's not so much directional, but it's not that far from changing if the market changes. So let's revisit one more time IWM and then consider trading. And we're going to then look at the implied volatility and decide. So if I now just zoom in here on the price action of the IWM, you would see that today we really have a very, very significant down day. We have a significant down day that has encapsulated pretty much the prior session and the day before and the day before. So this one bar that is today has completely negated the price action of the last 3 sessions. Could this thing break and go lower? Yeah, that's very, very possible. So in that case, if I really want to place an option trade, I need to look at right here and decide whether I should be hitting it with the calls or whether I should be hitting it on the puts. And Christian, you probably remember, good morning, Mark, as well, that when the gray line, which represents the put activity, is above the blue line, we can actually, in that case, hit it with the put spread. But in our case, these two lines are overlapping, so really there's virtually no difference whatsoever whether or not we're going to hit it with the puts or we're going to hit it with the calls. So what I have in mind to do this morning, now that I have observed this, is I'm going to revisit my existing IWM trade, because this is what we said that we're going to do. I'm going to revisit IWM trade, and then my real trade is going to be selling at the money bear call, and believe it or not, I'm going to right away buy at the money bear put. And I know you probably never even heard of this strategy, but this is a logic behind it. If I can just elaborate a little bit, bear call is supposed to give me a credit of, let's say, I don't know, if I make up the number $1 of the credit, and I'm making up the number because in a moment I'm going to use the top to actually price this. I should then pick the bear put spread for a $1 of the debit. So what should end up happening that I have a no cost trade with some maintenance. Yeah, with some maintenance, some margin. There's going to be some margin on. So this is where I want to head with that. But anyway, as I said to you, because I'm considering hitting it on IWM, I just want to quickly revisit this trade that we placed. Well, actually, that was a sharpening session. I went ahead and I actually elaborated that it was a bear call spread that was um, that was $2 wide, 212 selling the 210. That was $2 wide, and then buying the bull call spread that is $1 wide. And when you do the math, you actually end up with the credit of the 34 cents. So let's now evaluate where this trade is before we place another trade on IWM. And I'll purposely not trade the same cycle, which is in April. I will purposely not trade the same cycle that is in April. So I'm bringing up here my paper trading account, and I'm going to look here to locate my IWM trade. So this is not the one that I traded. Maybe it's in this one. Let me just see here. IWM. It's now to 205. So obviously, if the IWM is now at the 205, that means that we have a position that is actually looking very, very good. So I guess I got closed out of that trade. No, you know what? That trade has already expired profitable because it was April 1st expiration. April 1st expiration, that thing has expired for the maximum profit of the 34 cents because we have closed below that level. So we no longer have that trade, which frees us then to deliberately pick something else. So let's now look at the chart and decide that we're going to target this area down here. So we're going to look at the IWM and we're going to select the area in this area around the 200 that we are going to be aiming. So from current price of 205 and some change, I'm planning to hit the 200. That's my possible target. So when I click here, I'm going to go to the send to, and now using the platform to spell out to me what the strategy builder can do at the target that is around the 200. So I'm clicking this, and first thing that is popping up here is strategy builder. The strategy builder has a lot of choices. I'm going to hide this risk off just for a few seconds, and I'm going to jump on my opinion, the most important piece of information here, and that is a piece of information: what expiry should we pick. The expiry that should be picked is actually April 18th. Now, here are the several calls that are being several bear calls that are being presented for me in terms of the price selection, because there's a lot of information here. What I'm going to do right now, I'm going to just snapshot this, and I'm going to now take those bear call spreads and evaluate them in the pieces before I build anything else. So I'm putting that information in my column here for at the money, but I'm going to be now selecting if I like the strike prices. So strike prices that are given to me is the 205, 206, 204, 206, and 204, 205. So you would see that everything is actually centered around the 206, 206, 206. And if I bring, again, Thinkorswim platform here that is showing to me that we are currently at 205, and because we had the date on a platform that was April, quite remember off the top of my head, what was it? April 18. That's perfect actually, because April 18 is a regular monthly option, we're going to be considering doing the regular monthly option. Never mind that the platform has selected for us May. I'm picking the regular monthly option. I have a little bit too many strike prices here, so I'm going to reduce this, and I'm going to be now looking at intrinsic value. So let me just make this into two pieces of information. So if your eyes can be focused right here where I'm showing the volume. So I'm showing the volume here. You will notice I also have an open interest. What I'm going to do right now, I'm going to alter the open interest into intrinsic value because I'm dealing with puts right now. So I would point out to you now, not extrinsic, intrinsic value. Intrinsic value. That everything that is in the gray, it's out of the money. It's out of the money. So let me revisit one more time what I have cut and pasted out of it. And the way how I'm approaching this right now, and I want to emphasize this one more time because it's kind of unclear whether or not the top tells me that I must use that particular expiration. No, I don't need to use the May expiration, but what I could do, I can use the strike price that they have selected for me. So if I'm considering right now the bear call spread, 205, 206, 204, 206, and 204, 205, I need to choose one that I'm going to trade. So if I'm choosing the one that I'm going to trade, 204, 206, 204 and 206, right, would be good for the bear put spread. But what is the problem with my bear call spread? Well, this right now, 204 call, would be at that point in the money by the $1.27. So obviously that 204 selection, 204 selection and 206 selection, I'm going to again use the X to exit out. So now I'm looking, how about this one? Well, that's going to be also out of the question. So what I'm doing right now, I'm selecting the 205 and 206. 205 and 206. So let me start typing some of the numbers here for a bear call. So my bear call spread is going to be involving buying to open 206 call that is out of the money, and it's going to be selling to open 204, 205 call that is at the money. Okay, that is at the money. By same token, let me just create this into the table so it's less confusing for everybody who's looking at this particular session and follows what I'm trying to do. So my bear call spread is going to have these particular strike prices, and these particular strike prices are going to be identical also on the other side. The only variation that is going to be the fact that we're going to have a put here, and things are going to change in a moment here, but I want to make sure that there's no confusion what I'm talking about. So I'm building a bear put based on a strike prices that I have selected on a bear call. So having said that, all these other numbers don't really matter, so I'm not going to waste time on it. So 206 is being bought on a call side, 205 is being sold at that side, and it's giving me money. So let's now price this. This is only 20 cents, intrinsically speaking, worth something. So if I click this and I want to sell it, that is saying to me on this dollar wide spread, I'm getting the 53 cents. Okay, I'm getting the 53 cents. Let's say if this is a 50. Let's just say if this is a 50. Then me buying this one right here, buying the 206 and selling the 205 should also be at the same price. So 206 is being bought and 205 is more. It's actually for less. I'm actually be nicely in this trade. So let's just build this properly. I'm gonna finance the bear put spread with the money that I'm receiving from a bear call spread. So I'm hitting the control key. I'm placing right now sell. I'm going to go where it says a vertical. And I have this with the 10 contracts. I'm going to reduce it in a moment to less. But while I'm at it, I'm going to be also buying this and selling the other one. So I need to now make sure that I have a 205 and 206, 206 and 205. Okay, so let's now make sure that the quantity is correct. So I'm gonna open this wider so everybody can see when I start tweaking up, it's actually reducing it to 1. And doing this manually really helps you to actually slow down so you don't get yourself in trouble being emotional and rushing this particular trade. So do not rush this trade. Take a time so you're processing what you're actually doing when you're placing this trade. So I have a 1 and 1. This says a credit 10. There's no guarantee I'm going to get filled on a credit 10 or the 5, but I'm going to fire it in, and I want you to observe what is happening here. So I'm buying the higher strike price 206 on a call side, and I'm selling the lower strike price 205. At the same time, I'm buying the higher strike price on the put side that has the intrinsic value, and I'm anticipating that this thing is going to go below the 205, even maybe as low as 200, which means this 50 cents is going to make me $1, but this 50 cents that I got as a credit is going to completely expire worthless. So I knew that they're not going to give me that because it's supposed to be at zero, mathematically speaking, that they're giving it to me. So of course, I'm bargaining with them. I'm asking for more money than what it is. So I'm going to be canceling and replacing it. Wow, 9 cents. Okay, now let's talk about now details here. If I now create the duplicate order and just click on it, what is my maximum profit? Because I took a 9 cents or the $9. The most I can profit on this trade, it's $109, while my loss is that $100 minus $9 that I took, it's 91 cents. So now the trade has been placed, but I need to now spend the rest of the time, which is about 28 minutes, to explain it. And once when you learn this trade, this might be your absolute favorite bearish trade from all the trades out there, because really, I mean, it's almost like 100% trade. It's actually even better than 100%. When you look at about it, you're risking only $91 and your payout is more than $91. So this is a good trade. So the Mark and Christian and other attendees, if you like this trade, type in something in the chat box, because what I'm going to do right now, I'm going to just record some of this information and build it back in a top from the beginning to the end. From the beginning to the end. This kind of trade could change your life if you take a moment to kind of comprehend what is happening here. So basically, a debit is being paid by the credit. A debit is being paid by the credit. So I'm now placing this information right below here. So we have all the information that we need. So 205 call was sold at the price of the $3.38. This one was bought for the $2.85, which gave me a credit. On a put side, I actually bought a put, and here's the price, $3.51. And on lower put side, which is really out of the money, because on this case we're talking about with the put that is out of the money, and on this one we are talking a put that is at the money. And I do need to record where the price is. I'm going to show you a little trick how I actually do that when I'm placing the trade. So this right here is $3.07. So thank you for the feedback. I got 11 cents. Very good. Another person says, I like this. Um, yeah. Okay, Christian, I understand that you said the risk reward to 50 to 50 does not seem impressive. Now, what you're assuming that we're willing to risk everything to make that. We didn't yet talk about the stop loss. We did not talk about the stop loss because I can break this down into pieces and actually explain to you how much is really intrinsically worth, every one of them. Intrinsically, how much is this worth? So if you would just focus on this column, Christian, like it would actually make sense to you, because if we go ahead and close this trade whenever the time comes for us to close it, you would be still having some of the value in. So this, okay, so we're currently at the 205.46. Okay, here's the one little trick that I'm going to do. I'm going to go ahead and I'm going to sell just one single share of the IWM as a reminder where the price is. So I'm selling the one share. There's no commission involved, so I know where we are. We are at the 205.45. Okay, so that's supposed to get filled. Well, guess what? The price is no longer at 205.45 because I was talking too much. Now it's already at 2436, which is actually going my direction, which is down. So I would need to probably cancel and just give them the market order, just to get filled, So let's see what thing I get. I got filled at 37. Okay, so if I got filled at the 37, okay, so let's make sure that I have that information. So IWM is sitting at 205.37. Okay, 205.37. So that's mean that this 205 that is at the money, it's only worth 37 cents. So Christian, I want you to notice this, that this other $3.01 are fluff. Okay, are extrinsic value. And on this one right here, all $2.85 is also fluff. And the reason why I'm saying that's fluff, because what is the intrinsic value of that? Nada. None. If I now move to the put side, this one right here that we traded 206, when we are at the same price, I'm going to highlight this to make sure that it's clear. I'm going to maybe even make it in a bold. When we are at 205.37, that was a 66 cents in the money. So this at the money, I should say. This is at the money by the 66 cents. Then what about this other rest? That's the also fluff. And what about this? That's also a fluff. So be aware of it, that I do have a value here, that it's working in my favor. So when it comes to the stop, this is the one thing that I do now. You don't need to do it my way, but I'm saying, when would I know that I'm wrong? Well, if I make a comparison to the bus stop, and I get on a bus heading, in this case, south, and the bus start heading south, and for whatever reason that street is being blocked by the fire department and police because there's such a huge accident, and the bus that's supposed to head south is detoured to the point that into U-turn and head north, even passing my stop sign on which I entered, would you be then aware that you're heading in the wrong direction? You would say yes. So what can you do at that point? You can exit at the same place where you got in. So watch here. My high of today is a 209.43. If that is a high, I'd actually place the stop that when the price action turns not lower but higher, because for some unknown reason, let me again bring this here and see what the market is doing. There's a peace, love, and understanding all over the world, including you know where, in Europe, in Eastern Europe, and everything is looking good, right? Then I would be wrong. But what is happening right now in the market? Even the Dow Jones that was trying to go positive because of the weighting of these major sectors. By the way, the size of this box represents the S&P or 500 weighting. So technology represents the 28%. That's more than a quarter of the weighting or the sector weighting of the S&P 500. So if the technology is down, which obviously it's already down almost 2%, how in the world, based on a 28%, can the S&P 500 go higher? You see, the Dow Jones is different because they're not as exposed to it yet. But wait till the Amazon splits or the Google splits and go back into the Dow because they're going to be priced at the lower level. That is going to be, in my opinion, disaster. Because I don't know how many of you traded back in 1999 when the Dow, just before the technology crash, accepted Microsoft, Intel, and Dell. Only three companies, right? And then what happened in year 2000? Market crash. Well, the technology crashed, but the Dow went with it because they allowed three companies out of 30, and you can do the math, that's a 10% to go become a Dow Jones. So what is going to be in the future when Amazon splits, and Google splits at the lower level so they can be part of the Dow? That remains to be seen. That remains to be seen. So anyway, what I'm going to do here, because I want to go into the top and maybe place even one more trade, I just want to make sure that I place the trade on this, and I'm not going to place the target. I'm right now placing a stop because there's so many of my lessons that I've done in the past are about the placing the target. In this case, I'm the one about placing the stop. So one more time, where is the high? 209, and let's make 44 so we don't split this 4.3. Okay, so the way how I'm going to be placing a stop, and that's why I love to have a stock trade on, so you kind of understand how I'm doing this on a stock trade, so you can repeat it. You single right click on it, you're creating the opposite trade. You are now going over here to this little wheel that it says that you want to change a time in force. And of course, I will need to drag this in so you can see this. Time in force is going to be good to cancel, and order is going to be limit 209.44. So that's mean if we are at 209.44, okay, we're going to then get out. Save, confirm, read one more time. Buy to close at 209.44. I would never place this trade if there was a $5 commission or even a dollar commission, whatever. I'm placing this trade because there's no commissions, so you just kind of follow the logic, because now I'm dealing with the complex trade that involves the bear call and the bear put. So I'm sending it in. What? Okay, that's my bad. I should have put the condition on and I didn't. Never mind. Let me just repeat this over here on this one. Create the opposite trade. This is the way how it was supposed to be done. Okay. I was supposed to put the conditional order and I didn't put the conditional order. Conditional order was supposed to be done right here on this area. Submit when. Okay. Okay. IWM is method. At the market, at or above. Yeah, so that's what happened. Okay. 209.44. So when the price is at 209.44, and let's not rush this. Let me make sure that I proofread this and I don't make a mistake like I did earlier. IWM only when it's at or above 209.44, which is a high. Exit me at the market. At the market, not with limit. Now these numbers right now haven't changed. Of course, they need to put something to fill up these boxes. But what is really important for you to look at it, where's your break-even point? 205.54. So we have already passed the break-even point because we're heading down. So I'm going to send this, and now you're not going to hear the ding because I did it right. I did it right over here. So this is where it's sitting, and it's showing you the current pricing of it, and a condition is right here. Condition is right here. This is where the condition is saying that if you are okay. So let's now get rolling and maybe place one more trade on the top using the same kind of procedure. Let me now get one more thing here before we do anything else, because I do want to build this as a trade. So we're looking at let's see who is the weakest of the technology sector. I want to find the weakest of the technology sector. So we have a Google, we have Apple. Okay, let's look at the charts. Let's look at the charts. So I'm going to repeat the same trade twice. So if you didn't pick it up the first time, maybe you're going to pick up the second time. I'm looking at the Apple. Ooh, this is really, really bullish. This is really, really bullish. And yesterday we had a huge up day, and today we're just Japanese term is a harami. You know, this would be a mother and this would be a baby. Let me see if the Microsoft looks any worse than that. It's the same thing on the Microsoft. I don't feel comfortable shorting any of these things. Any of these things. I was thinking for education purposes only. Google is too big of the beast. How about the Netflix or the Facebook? How about just let me look. Netflix or the Facebook? Netflix looks pretty much the same thing. It has a huge. Yesterday bar was really big. We really ripped to the upside. We negated his down move of the last 3 days. Now we're giving more than half back. I still don't like the way how it looks. I'm looking for a bearish candidate here, and I know it's kind of bullish on it. Let's see the Facebook. No, Facebook actually looks even better. You know what? Let's consider doing this on a SPY. Let's consider this doing on a SPY. No, actually, maybe on a Q. No. Yeah. So, Christian, Mark, do you have a stock that you want me to look at it? Because I still have a time to place one more at the money. But I don't want to waste your time. Maybe you have a stock that you feel that it's bearish and that I can actually do this. So I know it's going to take a moment here to do that. I'm going to still search maybe NVIDIA. Oh, actually, NVIDIA is looking good. NVIDIA is looking good. Okay, let me see if I can speed up the execution of the NVIDIA. So NVIDIA. Yeah, it does have a good liquidity. So what will you do in this case? We will actually look at for the UFOs. UFOs are all the way down here, 220. We're right now at 263. Maybe I need to go smaller time frame. Let's try 55, just to see if we have any lower UFOs. Yeah, okay, we have a one at 257. That's about the $5 slower. Okay, so let's now do the steps. So you put the mouse before the UFO, and then you single right click, and when you go here where it says ascend to the top, right, Tractive Option Planner is going to build a strategy from which we're going to pick the A, the expiration, and then we're going to choose according to the liquidity we want, and then the B, we're going to select the strike prices. So I'm selecting 257.42 as my target. I'm getting the date April 14th. Similar to what I did earlier, I'm going to hide the risk graph. I'm going to start with the bear call spread. So I don't reinvent the wheel. I'm just cutting out this area, and I know this says May because the program actually builds it passing that day, but it says target date. So this is more conservative than what it should be. And what I'm doing right now, I'm now inserting here the new trade. This is going to be the trade on a NVIDIA that involves the strike prices 265, 270, 260, 270, 260, 265. So you would see around the 265, that would be the gut, what I like to call it, of this whole activity, of that whole activity. So let me now revisit here and just kind of remind you that I'm going to be picking the regular expiration for April. Okay, regular. The increments are 2.5 points. 2.5 points. Liquidity is quite a bit on these. Uh, this is really exciting. This is really exciting. Look at the 1,000. So I like the 260. I definitely like the 260. So what I think I'm gonna do, I like the 260 as a target. So if I pick this 260, 265, I don't like this. This is then in the money by the $2. Okay, I'm gonna spell out what I'm gonna do. You know, as much as this was trying to give me the correct strike prices, Nvidia has 250 increments. So from 250 increments, what I'm gonna do, I'm gonna be selecting that I'm gonna be buying to open 265, and I'm gonna be selling then 260, 250 on a call side. On a call side. That's what I'm gonna do. So how do we do this? This is 41 cents only. And what do they want? Christian, do you see this? They want $8.60. Mark, I'm going to look at the Twitter in a moment. Let me just fire this straight in. Okay, so how do we do this? Control key first needs to be pressed. Then you go sell vertical. This is going to load up. I'm going to actually right away drop it to $1.25. So I'm going to tuck this away, and I'm now going to click same thing, right? So I'm buying the 265 and selling the one at 260, 250. Now again, in this case, I would need to drop it manually. You know, for the next session, I'm going to actually change this because there's a default setting on the platform that I can do it, and I'll try to get it for a debit, when in reality, I should try to get it for zero. See if I'm going to get filled for zero. Bingo. I actually got filled at zero. That's wonderful. So over here it says you even got the credit. So this is a beautiful thing. When you get the credit, this is the way how it works here. Create a duplicate order. Don't send it in, but get the math. Okay. These are the 250 increments. These are the 250 increments. That's mean my maximum profit is that $20 of the credit I had gotten in plus the 250, correct? So that's $270 on the investment of the 230. This is very, very good trade. This trade is turning out to be even better than the other one that we did. Okay, let's jump into Twitter here in the last 7 minutes and do the same thing on the Twitter. Okay, Twitter. Ooh, Twitter is actually up, but that's because Elon Musk bought a whole bunch of shares on that. Let me evaluate that on the top with the top platform. So I'm going to evaluate that with the top platform. Yeah, this is a gap up. Yeah, I mean, right now it's pulling down a little bit. It says trade directionally, but this thing. Okay, if somebody puts a gun to my head and say like, "Do it, don't complain about it," this is what I would do. I would be looking at these green UFOs, right here. I would single right click. I would go where it says ascend. Now be aware if this is contrarian trade, but I'm teaching the strategy right now. Again, they're selecting the regular monthly option. They're selecting regular monthly option. I'm starting with the bear call side because I remember last time when I was teaching, I don't remember who typed in the text and said, I understand better the calls than the puts, so could you work with the calls rather than with the puts? And I'm like, just ask and it shall be given. So I'm now cutting the bear call side just to kind of follow that whole logic that there's no confusion of what we are doing here. So So we're not doing the video, we're now doing the Twitter. So this is a Twitter. So this is a Twitter. So again, everything centers around the, you see here they're taking into account 250 increments, which I like a lot. I like a lot this. So we're going to be still picking up the April regular monthly expiration. So we're still going to be picking up April regular monthly expiration. And look at the volume. It's insane. I guess it's all in the news that this is going on. So my target, I need to revisit the target. When I'm revisiting the target, I believe my target was somewhere here around 51. Okay. So if I know that my target on the Twitter is currently at 52 and some change. So if this is at 52 and whatever the change is with the target of about 51, then these numbers actually make sense, right? Okay. Okay, let's do it. Let's do it. So I'm going to add a little bit more strike prices so I see more. Wow, look at this activity. 10,000 contracts. 10,000 contracts right there. But I like the juiciness of this. I really like that. You know, I'm going to just make a $1 spread. I'm going to make a $1 spread. It's going to involve the strike prices 51 and 52. That's all that it's going to involve. So I'm selling this vertical and I'm going to bring it down to 1. And this is 45 cents credit. So now what I'm going to do, I'm going to tuck this away. I'm going to again use the control key and I'm going to actually do the, so this involves a 51.50. So this, but this is then out of the money. I don't want that. Then I'm going to pick the 52 and 51. That's going to change the whole strategy. That's going to deviate the whole strategy, you know, because if this is, I'm going to make a $2 spread. Forget that. I'm gonna make the $2 spread. I'm gonna make this into selling the 50, buying the 52 for a $1. So the other one should cost me also $1. Yes, other one should also cost me $1. Okay, so I'm buying the, so this is a 50 and 52. This one has intrinsic value. Buy vertical. Yeah, make this into 50. Drop this down to 1. This is going to be the last trade of the day, and then I'm going to post the first trade with explanation in that thing. Okay, now it's going to say debit, but I don't want to debit. I actually want to for even money. So now when I click on it, if you would not rush, if you would take a moment to read it, that's why I keep everything with one contract. Spread is at $2, so it says your maximum profit is $200, or the maximum loss is at $200. If I get the price improvement, that's even better. So let's just see if I'm going to get filled. Yeah, it's 8:58. I need to start wrapping up the session. So Mark, are you bullish or are you bearish on a Twitter? Tell me, because I'm placing this bearish trade because I've been teaching the bearish trade from the beginning to the end. I would like to see this on the risk graph, please. Yes, ask and it shall be given. Is it okay, Christian, if I give you this on the first one that we did, which is my IWM trade? Is that okay? So let me now go to the IWM, because I need to do that anyway later on to post. So IWM, let's just pick the bear call spread. Okay, so you bought it because it was in the news. Yeah, I mean, it has a gap below, so I don't necessarily feel comfortable with it going long, but sometimes news overrides everything. So I'm selecting here April 18th. I'm going to get rid of these other ones. And I'm going to go edit spread, because when I'm editing spread, I can do a lot of things. So what I have on on here, April, that good. So we sold to open 205, and I did get filled 205 for $3.38, and then I did 206, and I got filled at the $2.85. Okay, so this shows me that I have received on the bear call side the pricing of the 53 cents. I can just snap this before I progress and start doing the other leg. Okay, so now when I go edit spread, I'm adding two more option legs. And beautiful thing is that they're all going to be for April, but one is going to be sold, right? So one is going to be sold. So what I'm doing right now, I'm changing this into the put and a put. So the one that we bought was 206. So we bought 206 put, and this 206 put we bought for $3.51, and then a 205 put we did for $3.07. So just to make this clear, this is where I'm getting the numbers from. This is where I'm getting 338, 285, 351, 307. Because what is going to happen later, you're going to go into this trading with the UFOs, your supply session. You're going to have all those notes right there when I'm done with it. Okay, so what I'm doing now, I'm clicking OK. And now when I click OK, I can get the risk graph. So here's the risk graph. And when you're looking at this risk graph, this is pretty much how it looks. So this is the zero line. This is your maximum loss. This is your maximum profit. In fact, what I'm going to do right now, I'm going to even take a snapshot of this area and put it in a Word document that is going to get later published. So I'm going to just put it right here on the top. This, in my opinion, is the most important thing that you need to understand, right? That my profit, because I got filled for that extra 9 cents credit, extra 9 cents, pays off all of my commission. Excellent, Mark. If you got filled for 4 cents, I'm going to try to tweak it and see if I can get filled on 4 cents on the Twitter too. Yeah, right now it says a debit. Mark, was that that must be a debit? There's no way that you got the credit for it, because it just doesn't feel that that it's possible to get that. So I'm going to try to do it at the 4 cents and see if I get ding. Nope, they're not giving it to me for 4 cents. Meanwhile, I'm going to take a snapshot of the risk graph, because Christian, that's what you asked. And this thing is going to be posted later on. Let me just grab the whole thing. It's very important that I get this properly and then put it in a Word document. Okay, any last question before I start dismissing here? Because I still need to give the overview of everything that has taken place. And I want to make sure that you know that this strategy builder has labeled this strategy as unknown. But in reality, it's basically a debit spread that is being financed by the bear call spread, right? So the bear put is being financed by the bear call. So in other words, the credit that we received had paid for the debit. So what do we do today? So we started with the big picture, and I hope I didn't overkill, like with the amount of evaluation that I did. But without that evaluation, we wouldn't be able to decide which way we went, right? So we selected IWM as a bearish bet because overall market was kind of heading lower, and we felt that that would be a good choice. Now, again, be aware of it. Now it's in noon time in New York. That's where usually market slows down. These are the 10-minute bars. There's not much going on, so you can maybe come and trade a closing session. But for the next few hours, I mean, if this thing didn't go lower, like really, I mean, you need to give some time to know whether or not this is going to have another move either up or down before the end of the session. So again, these notes that I did on a number of them is going to be posted on tradingwithufos/Josip. We have fired so far here successfully 2 trades. This is still not giving it to me. I'm going to go to the 3 cents. They're still not giving it to me. Anyway, maybe it was never meant to be. I'm going to give them this last one, and I'm going to just type it 13 cents. I just want to place this trade on so I have something to track later on when we meet. And I'm not going to give them anything more than 13. So let me read the comments. So do we need to put stops on this trade? Yes. If you got filled, which obviously I didn't, then you would need to go. So see, I still have this working order on Twitter that I didn't get filled. I personally, this is what I would do. I would look at this number right here that is the high of the day. So this number right here that is the high of the day would be where I put my stop today. Or what you can do, you can wait for the end of the day and then put it on. Because I don't know the size of the account, but many times the traders who don't have a $25,000 in and they put the stop and your stop gets hit, then they get counted as day traders. So just be aware of it that you can wait for the end of the day, put it on. But what about if the market turns and goes up? So anyway, the way how you would do it is exactly the way I showed you. You would click here, you would go opposite trade, and then don't make a mistake that I did earlier. You need to click this wheel, and then on that wheel, there's a section right here, not to submit the time, but to submit the when. In a default setting, it's reading when we're at or above. This is where you would type in the number. So I hope that answers the questions to all of you. And I want to tell you one more time, thank you once again for attending this session. I really enjoy teaching it. And as always, stay hedged and have a good day. Bye now.